Hi there. Okay, so this is the second part of the lecture week 12. It's still dealing with the analysis of subsidiary journals, but just a continuation from the CRJ and CPJ. So the outcomes are you must be able to process credit sales and purchases, and you must be able to complete the credit journals and the returns journals. So in the first part of the slides, we did the CRJ and CPJ, which dealt only with cash transactions, and now we are dealing with all the credit transactions. So the first journal is the purchases journal, and as the name suggests, it is the journal which we use every time we make a purchase. But what you need to know here is that this journal is only for credit purchases. Okay, so the slide says the journal is used for entering all purchases on account, so that means on credit. And then it says in all these instances, the accounts payable account will be credited, resulting in an increase in liabilities. So every time we purchase something on credit, it will go into the purchases journal. Now previously, every time you purchase something on credit, you would have taken it to the general journal, you would have debited perhaps your inventory, and you would have credited accounts payable, which technically is incorrect because we are trying to filter our information out to the correct journals. So the purchases journal is used for credit purchases. So whether you're buying stationery on credit or whether you're buying inventory on credit or anything else, it goes into the purchases journal. This is an example which is on the slides which you can work through on your own time. I'm going to try to work through it with you just by explaining to you maybe one or two of the transactions. So if, for example, by number 1, it says you purchase goods on credit from A Apple for 1,140 Rand. So this kind of transaction would go into the purchases journal. And I know that because it says, first of all, you're purchasing goods, which means it affects inventory. And it says on credit, which is the most important part of this transaction. So the fact that you have purchased something on credit means it goes to the purchases journal. And all of these transactions is a purchase transaction, which is on credit. So all of these transactions will go into the purchases journal. Something else which is important is the same way in the CRJ and CPJ, I said you will always have a bank column because bank is always affected. Now in the purchases journal, you will always have an accounts payable column because accounts payable is always affected. It's always you buying something on credit. Okay. The next journal is the sales journal, and as you can imagine, the sales journal is obviously now when you are selling things on credit. So every time you make a sale to your debtors, it will go into the sales journal. So let us quickly filter this information. When you sell something for cash and your customers pay you immediately, it goes into the cash receipts journal, which I did in my previous video. But when you sell something on credit and it affects accounts receivable, it goes into the sales journal. Now previously, every time you sold something on credit, you would take it to the general journal, which is technically incorrect because the proper place for a sales transaction is the sales journal. So you can now imagine that in the sales journal, you always have a column for accounts receivable because accounts receivable is always affected. So here's an example now on the cash receipts, on the sales journal. There are 4 transactions and each one is you are selling something on credit. So it says you sold goods to Sure on credit for 9,120 Rand. That is your sales amount. So 9,120 Rand will go to your accounts receivable column and your sales column in the sales journal. What's important to note here is the first bullet point on the slide says markup is 50% on cost, which already indicates to you that you probably should have put cost of sales somewhere. So it depends which method you are using. If we are using the perpetual method and we are recording cost of sales, then you need to have a column for cost of sales in your sales journal. But if you are using the periodic method, then you already know that you will not update cost of sales. So you'll have no column for cost of sales if you're using the periodic method. Okay. Then the final journal here is the returns journal. And the returns journal is when you are returning goods to your supplier or your customers are returning to you. So you have separate journals for these type of transactions. So you'll have a journal called sales returns journal for when your customers are returning goods to you. And then you have a journal called purchases returns journal for when you are returning goods to your supplier. Now, and again, an example on all of the returns, all of these things are either you returning goods to your supplier or the customer returning goods to you. So again, in these journals, you'll have specific columns, and you must know in which column to put the amounts. Okay, and then lastly, in these journals, you might also have sundry accounts. So let's take the purchases journal, for example. The purchases journal is you are buying things on credit. So you'll have specific columns which is common. So for example, you know you're going to buy inventory a lot. So you'll have a column for inventory in your purchases journal. You may have a column for stationery, for example, because you know that you purchase stationery a lot. But then you also have a column for sundry, for the things which you buy on credit, which is not common. So for example, if you purchase equipment in the month, you don't purchase equipment more than once in a month, most likely not. So you'll then put equipment under your sundry accounts. So the columns here are important because you need to know which columns have to be in the journals, but you can also play around with it. It doesn't have to be standard. So you have to have an accounts payable column in the purchases journal. You most likely will definitely have a column for inventory in the purchases journal, but then you don't have to have a column for stationery. So it's actually you do what you want to do in those journals and which columns you want to open. Okay, then the final journal is the general journal. So now, so far, we've put everything in the general journal. But now with the subsidiary journals, it shows you how to filter your information through all of the specific journals. So we put all cash transactions in the CRJ and CPJ. Then we put all credit transactions in the sales journal and purchases journal. So what is then left for the general journal? The only thing that is now left are your adjustments. So for example, your bad debts and your depreciation, those type of transactions will still go to the general journal.